Hey everyone, welcome to the Mike Rosehart Show, live every Wednesday, including this Wednesday. Daylight savings time makes it such that I have a beautiful view out my window. The sun is still up, which is very rare. It's been well over 6 months since I've done a Wise Wealth show or a Mike Rosehart live show where I've had the sun up. So thankful for that today. But today, what are we talking about? First 30 seconds, I always just ramble, but we're talking about how to invest in a recession today. And how do you invest in a recession? Well, the first thing to do in a recession is hold on to your hat and keep calm. Hey, Future Wiz, good to see you on. Hey, everyone, good to see everyone jumping on. Just jump in the comments and say hey. Kids College Life says, hey, Mike, I really appreciate your streams. Thanks. William says, hey, market is crazy. Mike, how you doing? Good to see you too. All the great people jumping on. Appreciate y'all coming on. Yes, the market is crazy. If people are following, the Dow is entering a bear market. The TSX, Toronto Stock Exchange, is entering a bear market. The beat up of oil prices and the current, oil war, so to speak, between Saudi and Russia is in fact creating quite the recession here in Canada, mostly because a lot of our index is natural resource focused. So in places like British Columbia, in places like out east, in places like Alberta, the primary driver of provincial GDP is things like the oil sands or offshore drilling and things like that, right? That are tied strongly to oil. Big deals like OPEC and things like that are all tied to the price of oil. So there are significant ramifications due to oil, but it was all the catalyst that no one saw coming, that even I didn't see coming, that has started this, we'll call it recession, or I guess it's not a recession yet, but started this sort of bear cycle we've seen in the last week, is the coronavirus. And I want to start by saying, if I get the coronavirus, because like my luck, I'll talk shit about the coronavirus and then I'll probably get it. If I get it, I'll still be doing deals. But the coronavirus is not actually as scary as people think it is. There are much more deadly spreading viruses, things like the chickenpox, spread at a much higher rate than the virus. And in my opinion, it's not that deadly because it's a respiratory illness, right? And if you're healthy, if you're like my age or like 35 or like, under 50 and you don't have asthma, you don't have any like major health issues, coronavirus is like a cold. It's not even as bad as pneumonia really. So medically speaking, I'm not a doctor, but from what I've read online, it isn't that big of a deal. But corporations are closing down global headquarters. People are being sent home. Everyone's told to work from home. Stocks are being beat up 20%. Airlines, travel, cruises, all that kind of stuff. It's all getting smashed. And all at the same time as oil is in the shitter. So terrible time, economically speaking, for countries like Canada. Our currency has taken a huge, huge dip. In fact, the currency alone has cost me personally, probably $60,000 or $70,000. I've taken personal losses. But what I know is that in the long term, how do we invest in a recession? Well, I know in the long term, the market does this, moves upwards over the long term. There are fluctuations. This is a fluctuation. What I know is we can't predict the future. None of us know with absolute certainty what will happen in the future. It could be like a dead cat bounce type of recovery. We could see maybe they find a cure for the coronavirus. Maybe it blows over like SARS and every other. If you check out my Instagram at Mike Rosehart, you can see every year there's been something from like Ebola to SARS to like Norwalk to like and now people are talking about some other. There's always something, right? Throughout history, every year the media has picked up on something and made that like a focus, right? Coronavirus is getting way more coverage than I think it needs to get. I think people are overreacting. The fact that there's no toilet paper in most stores right now, the fact that like hand sanitizer is being auctioned off like 400%, that's irrational behavior. And what do we prudent, smart fire investors do when the market is irrational? We sit back, we think, we analyze, we keep our cash ready, and we dollar cost average and we buy in. That's it. If things are trading at a 15 or 20% discount, dollar cost average, and continue to buy in over time. That's what you do. Fear is not a good way to, you don't even let fear sit in your investor analysis. Like, I just remove fear entirely and I look objectively, is this having a huge impact on, in the long term, is this going to have a huge impact? I don't think that's the case. I think this virus is killing healthy people at like a 0.02%. Like, the only people who are dying are old people who would have died from like the common flu, like, you know, in like 5 years. So I don't want to be like too harsh or too insensitive, I suppose, to the coronavirus. And like, if I end up getting it, because I'm sure a lot of us, it spreads pretty easily. So I'm sure a percentage of the population is going to get it, right? And is it gonna suck? Like, you guys, if you guys ever see me up close, you can see I have a scar right here. I have a big scar right here. You can't really see it because my hair grows around it. But I got chicken pox when I was a kid, really bad, like really, really bad, like almost had to be hospitalized. And even that, like a virus like that, it's not a big deal. Like, you have a scar, you move on, right? I don't think that it's really attacking healthy people. And I think that the fears of mutation are overblown. I think that, I don't know, I think the market's overreacting. And I think that this could be a good time to buy. What we know is this. We know from our last week's stream that the Feds cut interest rates 50 basis points. The bond traders are pricing in another 75 basis points, so I've heard. So we're talking about a 1.25 or 125 basis point cut to interest rates. Some countries are putting in measures to actually have negative interest rates lending to certain small and medium-sized businesses right now. So in my mind, that's a huge catalyst for borrowing, for levering up. Now, most people are gonna they'll be afraid, right? Because it's a recession, whatnot. In my opinion, like, I'm a real estate investor, right? People are going to need somewhere to rent, no matter what, coronavirus or not, they need somewhere to live, right? And I don't think it's a big enough issue it's going to knock off a large percentage of the population. I don't think it's going to happen. So it's not going to affect rental rates, hardly at all, I don't think. So that's not going to affect anything. And I think with lowering interest rates, we're going to see an increasing cash flow on our properties. And so real estate is more attractive than ever. It's like putting gas on the fire. So this might be a good time to say, hey, over the next 6 months to a year, maybe by next spring or even this spring, you might say this is the hottest market we're ever probably going to see in Ontario specifically. I'm seeing this. It might be a good time if you have properties with lots of equity in them to sell. Might be a good time to sell, to cash out. It might be the top of a bubble. This could push real estate even higher. It's going to push things like gold. Gold and silver is gonna jump, right? People are gonna flock to the safe havens like real estate, like gold, et cetera, and so forth. If you're big on commodities and you like oil, oil is on sale right now. Long term, I don't know where oil fits in. Like 50 years from now, if we have a new technology that doesn't require oil as a fuel source for our vehicles, for instance, if they're all electric, right? And we use like solar and wind to generate and water and things like that to generate, like hydroelectric, to generate all of our power, then there may not be a place for gas stations where, you know, crude oil might not be as valuable anymore, right? And so it's possible that long-term oil will go to zero. Like, I have a lot of people who say that, like, oh, oil's got value, blah, blah, blah. Let's remember that, like, the Canadian oil sands, as an example, some of these companies, depending on the size of the company and how efficient they are, it's $40, $50, $60 a barrel to extract the oil out of the ground and get it to you. And when oil's at, say, 25 or 30, they lose 30 bucks or 20 bucks for every barrel of oil they pull out of the earth. So what are they going to do? Stop pulling oil out of the earth, right? Now the Saudis have a competitive advantage. Their labor rates are much better. They have, their land is literally like spewing oil, so it's easy for them to get it out. But in places like Canada, the Canadian oil sands industry is going to be destroyed because we can't cost effectively get the oil out, right? At a cost that is profitable. So no one's going to invest in that sector. And maybe long-term, that is the case for some producers, right? Some manufacturers, some even like down the chain, right? People who refine that crude oil into gasoline and things like that, right? That's going to affect all their businesses. So there'll be job loss there. That'll have economic ramifications that will affect real estate eventually. So I think that what they're going to do right now is pour gas on the real estate fire that's going to create a bubble in real estate that will eventually pop. So 2 or 3 things that happen in Ontario, specifically in Canada, that have recently, I guess, been catalysts to this theory, and this is just a theory that I have. One, we've seen an increase in demand and a decrease in the amount of available supply. They can't build enough to satiate demand, and rents are at an all-time high. Demand for rentals is at an all-time high. Two, they just dropped interest rates 50 basis points. There's a 50 basis point rate hike cut, rate cut, not hike. That means increased cash flow. That means better able to qualify. The third thing is the stress testing rules. They snuck it out there. I don't know if you guys are watching, but they changed the mortgage stress testing qualification rules here in Ontario and in Canada. So there no longer is, there was a qualifying rate that was like 5.5%. Now it's your approved rate plus 2%. So where we see interest rates, there are some variable mortgages in the next little bit, I am guessing there'll be 1.79, 1.69 5-year variables. I think that's going to happen. That's my prediction. So hold on to your pants if you want to refinance, because I think it's going to get really, really cheap. I think we're going to be able to borrow money maybe at almost free. And so in those situations where we can do that, where we can lever up for free, it's really attractive to buy stable assets like real estate that self-service the debt. That's extremely attractive in my opinion, right? If you can buy a property that cash flowed $1,000 a month, well at 1.79 5-year variable, it now cash flows $1,800 a month. It is even more desirable when the market is in turmoil and you can get consistent, stable cash flow every month. Real estate, it is very desirable, especially when there's a latent factor of economic, like job loss, for instance, right? The effects of like the coronavirus, the effects of oil. Let's just look at oil alone. The crash in oil will have ramifications. People will end up getting laid off. That will affect the economy. But that's 6 months or a year from now. Those people, right now, they're getting paid. They have money. They're not putting their house up for sale, right? There's no effect on the real estate market yet. So real estate's a lagger. It takes time for things to catch up. So I think that we will go into a bear cycle for real estate, but I don't think it's going to align with the crap. I think the cycles are not going to align with the markets. So I think it might be over the next 12 months a good time to sell some property. I could be wrong. And if it cash flows, keep your property. But if you have property that doesn't cash flow, I have some property. I have some land, for instance, that is like a small subdivision that I'm developing. It doesn't make sense to hold that. In the next year, I could cash that out and make $500,000. That's a good, take the $500,000 bucks. And when the market's bare, I'm going to invest in equities. Because when the market is trailing downwards, I'm going to dollar cost average and just keep buying. And I'm going to buy a lot of equities. And what's going to happen is that statistically speaking, after every single bear market, within 3 years, there's a full recovery, right? And then some. So what we know is that in 2008, when we thought the world was ending, by 2010 or 2011, everyone had made money. They just held and diversified. So the key piece is, how do you invest in a recession? You diversify your holdings. Buy exchange traded funds. Buy a collection or large basket of stocks from different sectors, right? Different sectors is key. You want to own many companies from many different industries. That way, if one industry tanks, oil, then you're not screwed. Your whole portfolio is in oil. It's like 10% oil. And you took a 10% hit, but that's okay because, hey, you did a pair trade and you bought another stock that had, I don't know, Tesla or something. I don't know. Some company that's not tied to the price of oil that doesn't affect it negatively, right? Maybe you could even trade on a company that was, you could buy an option, for instance, right? Where if the price of oil went down, you made some money on your options, right? So you could build a portfolio that was resistant to, I guess, short-term fluctuations, right? In the long term, so long as you don't need to liquidate, if you just hold what you have, it will recover. And that's what we know. Investors make money always. Money makes money always. So if you're invested in the general markets, Brazil, Russia, India, China, America, Canada, all of the different indexes, and you own many different companies and all the different indexes, you will not lose money in a 5 or 10 year period. Fact. So relax, it's going to be okay. Probably don't buy individual stocks unless you want to take a lot of risk and gamble a little bit, because you could lose money. Now let's go to the Q&A, and I'll go back to talking in a second because I saw a lot of cool stuff popping up and I want to address some of it. So, do you believe this could affect the rental market? So the question was related to coronavirus affecting the rental market. Yes and no. To the point that it's possible for someone to maybe move because of coronavirus, that could affect, like, if a city got really, if everyone was infected with coronavirus in like a certain geographical area, I could see where there'd be a decrease in demand to move there and rent the space. But by and large, people need a place to live. People are on long-term leases for 12 months or 24 months. So if you get coronavirus, you're still renting your place. You're sick at home, and you'll recover, by the way, because most people recover from the coronavirus. It's not even like you're gonna die. It's not like cancer. It's so minor. So you get it, you're sick for a bit, and you recover. Like that's what happens if you're healthy and you're not like 80 years old with like a pre-existing condition. But yeah, I mean, how's that going to affect the rental market? Maybe I'm missing something. Jump in the comments. If I'm missing something, let me know right now. Be like, hey, Mike, what about this? Let's brainstorm this together. Can we think of a scenario where the coronavirus really has a major impact on the real estate market in the short term? I can't see it. I can see the Bank of Canada cutting interest rates another 75 basis points, throwing gas on a fire. Like, I want to buy as much real estate as I possibly can that cash flows and by the way, qualify your real estate cash flowing at 5 or 6%. And then when you get it at 2% interest rate, you're making all that spread, but prepare for a higher interest rate, right? But yeah, I think overall, the rental market will stay strong. I don't think the rental market's affected by coronavirus in a major way. What we'll see is areas like trade will be affected. We'll see areas like travel. Travel's hugely affected, right? People don't want to travel. So people are going to keep their money back. They're not going to go on as many trips. Companies like Disney will be affected for sure. People like me who own vacation rentals near Orlando and Kissimmee, I'm going to be affected, right? I've already got cancellations on my bookings. We had a corporate retreat at the Mansion Castle, and my partner and I are already feeling the losses of one of the 1 week cancellations, right? And that's a short-term fluctuation. Long-term, I think we're going to be just fine. It's going to give us a chance to add value to the property. So I like the silver lining and the positive in everything that we're doing. And I believe in the assets that I'm holding long-term, or I'm selling them. So yeah. I think it's obviously not a good time for people in certain sectors, but I think real estate is going to be just fine. Mike, sure, my parents refinanced. They got a house in 2008 for $265,000. Now that house is worth $400,000. It's at a 6% and payment is high because of low down payment, 7 to 10% down. So yeah, I mean, if you're at a 6% interest rate, you should definitely refinance, barring like a crazy high mortgage breakout penalty. I doubt that exists, but if it does, I mean, you got to factor that in, run your numbers and say, hey, if I can get a mortgage right now at 2.79 and I'm at 6%, assuming your parents can qualify, I don't know what they do for a living. I don't know why they got a 6% mortgage in the first place. Typically, high ratio mortgages have lower interest rates because they're insured, right? But I don't know. So yeah, definitely 6% mortgage. Go get refinanced like 3%, 100%. That's a no-brainer. That will cut your interest rate on your mortgage in half, right? So that's an easy no-brainer. Definitely refinance your parents' house. And if you wanted to take out as much equity as you could from the house, now's the time to get it appraised while the market is hot because of the catalyst of low interest rates, right? So real estate prices are going to go up even further. You'd think that the decrease in demand or the instability associated with coronavirus would have a negative effect on real estate, but typically what we've seen is that real rents stay stable, and when you cut interest rates, cash flow goes up, so demand for rental properties that cash flow, it increases further. Will we see $1 million houses affected negatively? Yes. Like the house that no one's buying as an investment property, that like mansion that doesn't cash flow, that can't be like a short-term rental, that's on the outskirts of town in the burbs, that house is going to be affected negatively probably. People are less likely to move when there's a coronavirus going on. People are less likely to relocate. People are less likely to take big risk when the market's not stable. So certain sectors in real estate will be affected. But I think that the interest rate hikes or the interest rate cuts will hike prices to offset a lot of that, and especially cash flowing real estate. Like your average house, detached house, is going to be positively affected. Most houses like condos will be positively affected. So I think that most real estate will actually be positive for the real estate market, which is crazy because you'd think like, how can it get any better than it already is? It's already been so hot and so crazy, but it will go higher. We will see. And I'll regret the properties that I've sold, I'm sure, as I watch the market come to the top of a bubble. Yeah, so future, it doesn't really matter if it's a small house or not. I think definitely an opportunity to refinance. You should take it. So Fire Junkie says, the danger with Corona is its capacity to mutate wildly. Even if they manage to get a vaccine going in the months to come, it would have to spread and mutate several times around the world. Or it would have spread and mutated. So yeah, I mean, you're right. Like maybe a vaccine isn't possible for the coronavirus because of this like wild mutation. Do I think it's going to wildly mutate? I don't know. I'm not a scientist. I can't begin to speculate on that. What I know is that what I know currently is that if I got corona right now, it wouldn't kill me. I bet money on that. There's good enough odds that I bet money that I'd survive and be just fine. So is it something to really worry about? Like, am I gonna like? People are, for instance, walking away from huge amounts of money, like doing stupid things for their companies to try to avoid this virus. And it's like most companies take no measure to protect against the common cold or like pneumonia, right? Like they don't do anything. But now this coronavirus, which is like slightly worse than a cold, they're like, the world's ending, right? I think it's a little bit overblown. I think it's a little dramatic. You know, if you're old or you got pre-existing conditions, maybe there's something to worry about there. Yeah, I mean, I just don't see the worry there the way that you're worried about it. I don't know. I've always taken the stance that like everything will pass, everything will be fine. People get worked up. I don't get worked up, and that's why I make money. I think if anything, this might be an opportunity to buy. If I see another 10 or 20% drop, I'm going to start buying equities. Like I'm excited to buy because I think it's an opportunity finally to get in, where I've been sitting on the sidelines waiting as the market's roared for the last 12 years, the biggest bull market we've ever seen. I think we're due for a correction. It's a good catalyst. People have been too bullish for too long. I am worried though about negative interest rates, about hyperinflation, about some of the mania, some of the negative effects that the mania can cause when people get irrational, right? They make stupid decisions, and those decisions have lasting impacts sometimes. So, yeah. Good points. All great points. And by the way, everyone who's here, all 65 of you guys who are live right now, smash that like button and jump in the comments and say hi and drop a question. So people rushing into Costco to get toilet paper and water as soon as it opens is the best. Agreed. I think it's irrational. Okay, next one. And by the way, this is coming from someone whose mother texts him daily, like for the last, on January 4th, before it was a thing, when the first couple cases came out, my mom was like sending me news articles. She's like, oh, like coronavirus is spreading. It's going to get out of China and get everywhere. And I'm like, Mom, just relax, like calm down. Like my mom's always all over like the biggest news. And she's always like, even like yesterday, she just texted me like the current updates about coronavirus. And I ignore it. Like I ignore the news and try just to not to hear it, because I don't want it to affect my you don't let my emotion guide your investing decisions. So that's what I'll say. That's how you invest in a recession. You don't get emotional. You say, long term, will this company be here? And if it's short term affected for a year, do they have the cash reserves to hold out that year? That's the real question. Either they do or they don't. So that's the question. Finally caught the live stream. I'm glad you caught it. Welcome on. Would you invest in Tesla right now? No, but I wouldn't have invested in Tesla before the coronavirus. Not because I don't like Tesla. I'm going to get a Tesla. I love the vehicle. I drove one when I was in Florida, and woo, thing's fast, it's smooth, it's self-driving for the most part. Just a well-made vehicle, and it feels more like a cell phone than a car, which is cool. I love Tesla. Do I think it's overvalued? Yes. I think that it's trading at too high of a multiple right now. But I mean, at the right price, I'd buy anything. So there's my dog in the background. Average age of people that get coronavirus is 80 years old. Kids don't get it, and most people don't know if they have it because you feel no effects. There you go. That's why it spreads so easily, but it's also not that dangerous. Someone says oil is the best right now. The best if you didn't own it before, maybe. The best if you're filling your truck up or your car with gas. Who is predicting a fairly probable likelihood that it reaches certain bat populations in Brazil, that it can jump to 15% lethality rate? So lethal for who, right? Right now, it's not killing any healthy people. It's killing, it does a great job of killing people who are sick. Like if you have an issue, it'll kill you quick. But I mean, if you already had an issue, your life expectancy was what, like 5-10 years? So it's killing people who are old, who primarily have issues that would have killed them anyway from a common cold. It just accelerated that process. Now, it might sound really cruel, but I think that we're overreacting. Yeah, we'll see. I could be wrong. I've been wrong before, but I'm not overreacting about it, and I'm gonna still travel. Obviously not to like high risk areas, but I'll be checking on my properties in Florida. Hey, I noticed you recommended finding the best use of each property you invest in. In London, students like to rent by the room, so more rooms is better, or duplex conversions. Jordan, yeah, great question. Yes, primarily true. In a student rental market, the more bedrooms that you have, the more bathrooms, the more that you're going to make. A 4-bedroom unit rents for a lot more than a 3-bedroom unit. Some people, some property managers I know, they purposely don't like to put a lot of bedrooms because it's more work to manage. So they'd rather a 3-bedroom unit renting for $1,500 than have you have the same space turned into a 4-bedroom for $1,800 a month. They'd rather you lose that $300 cash flow because there's one less person for them to manage. So just be careful. Don't listen to some property managers. Some realtors just want like a clean, simple deal. And if you're trying to maximize cash flow, then that does take a little bit more effort, obviously, like build that extra wall and put that door in. But I think that it pays off. And yes, almost all of my properties, I maximize in that way. Don't really worry about the virus until you start hearing about South America cases. Yeah, I haven't heard much about South America cases. What strategy do you recommend for cities that aren't booming to the same extent as London? I'm talking about cities like Calgary, where the immediate future is uncertain. Be careful in what you buy in those markets. I think that you're going to see in the next year a bit of a slowdown in those markets like Calgary. If you're buying property like duplex and triplex that cash flows well, it doesn't matter what happens to the price, because 10 years from now, your property's gonna be worth more than it's worth now. So you will make money in the long term. That's what we know. We don't know short-term fluctuations, but in the long term, you will make money. What we know is that if you buy things that cash flow, you're gonna be in a good position. That's the secret. Buy stuff that cash flows, that gives you money in your pocket every single month. So you don't care what happens to the price, so long as you can rent the property out. If the coronavirus spread in a country with a high HIV population, the mortality rate would skyrocket. Yeah, it's probably true. It definitely does prey on those that are weak. Where do I find properties in the USA that cash flow $1,000 a month? How big of a down payment do I need? So Future Wiz, you could go into the Midwest in the United States and you could find properties for like 50, 60 grand that rent for like $1,000 a month. And so your cash flow will be like $500 a month and your down payment could be like very, very small. So there are definitely properties in the Midwest where you can get insane like 2% rule type properties. So look in those markets, definitely. Even in New York, there are spots. I talked to someone who was buying in a small town, like 3 hours from New York City in New York State. And they were finding cash flow, like 2% rule, like $60,000 properties. Oh, my battery's almost dead, guys. Properties that are like 60, 80 grand, they're renting for $1,200, $1,500 a month. So that's got great cash flow prospects. So those deals are great. Definitely look in those areas. Don't look in New York City. Don't look in LA. You're not gonna find cash flow there. Okay. Next question. If you lived in Vancouver, where would you invest? Locally or a 5-hour drive or a different province? So Michael Lee, great question. If I lived in Vancouver right now, I would buy one property and I would house hack it. I'd buy like a 10-bedroom property. It's like a duplex, or I can make it almost like a triplex. I'd live in one of the units and I rent the other units out. I'd rent the other bedrooms out and I'd live there. I'd house hack. And that would allow me to have control over my residence. I would own it. I'd get some appreciation and I could break even at least. I'm sure the other bedrooms rented out would cover my cost of living. I wouldn't buy any rental properties in Vancouver at all right now, at the current price point. Nothing even within an hour around Vancouver. Like everything I saw there was super overpriced last time I was there and the time before that too. It just doesn't make sense. It doesn't cash flow. And so if it doesn't cash flow, you don't want to hold it. That's my thought. So maybe just buy a REIT where you can get a 10 or 12% return or do some lending. Next question. I'm hoping to pull out $20,000 of extra repayments for my mortgage to throw at these really cheap stocks. Sounds like a good idea. If you were to do it over the next 3-4 weeks, you might see further declines and you could dollar cost average down, because we don't know what the bottom is, but we know that buying at a 20% discount is great. Maybe it'll be a 40% discount in 2 weeks. I don't know. But what we do know is that it is cheaper than it was 2 weeks ago. So it might be a good time to buy. We're seeing all the gains for the last year are eroded away, right? So you're buying at last year's prices, which is good. And you might be able to buy it at 10 years ago pricing, if at the bottom of the market, you were to time it perfectly. But as we know, time in the market over trying to time the market. Time in the market over timing the market. You can't time the market, none of us can. Some of us pretend that we can, but none of us really can. That's why we buy asset classes that we believe in long-term, that provide cash flow through dividends or through real estate through rental income, as an example. That's what you buy. You buy companies that have huge cash reserves that could withstand 3, 4, 5 months of no like profit loss, right? Losses. So that's something to think about. Okay, next question. Good evening from the UK. Hello. If Corona kicks off a heap of oldies and boomers, won't there be an influx of available properties? Prices would plummet. Yes and no. For the most part, what people do when their properties, like when they kick the bucket, is their spouse or like their brother or their kids take the property over for the most part. And then some later point, the property is eventually sold after it goes through probate and et cetera and so forth. If every party wants to agree not to keep it or buy each other out, then they put the property for sale. But in a burning hot real estate market like the one we're in right now, people want to hold on to real estate. It's not until there's blood in the water that people actually want to sell real estate. So people are actually, like in times of turbulence like right now, people are flocking to real estate. There's an increased demand, more than before. They cut interest rates, so people are all wanting to get into real estate. It's a safe asset class in a recession, right? It cash flows. It's not in the same cycle as the equity markets. It's not tied in the same way. So people are attracted to real estate right now. So I think that what will end up happening is we'll see the curves, the cycles of real estate and equities not overlap this time. I think what we'll see is that the real estate market will boom while the equities will drop, and we'll be able to refinance our properties and then buy a bunch of equities, fingers crossed, hoping I can refinance $1 million out of my properties and then buy a bunch of equities and then ride that up, take my $1 million in equity, turn it into a couple $1 million, getting itchy palms. I don't actually know, but that's my prediction. It's based on some level of sophisticated assumption making. And let's not forget, I'm a Scorpio, and Scorpios are great at making assumptions. Just look at our horoscopes. We actually make really, really good, our intuition or our gut is good for making assumptions. It makes us good in business, actually. Scorpios tend to be very, very good in business for that reason. So I've been right before. I work in the travel industry. It's not looking great for our company. That sucks. Sorry to hear. No one wants to travel right now. So if you're a small company with low cash reserves, you might go under. So if you're going to short some companies, pick some ones with crappy cash reserves, and for the next 6 months or a year, you might see them crash to bankruptcy. So yeah, there could be opportunity if you knew how to time the market to buy some put options and short those companies. What ETFs do you recommend, and can you explain what a DRIP is? Also, would you start filling TFSA RRSP first? So Logan, it depends on a lot of, that's a really loaded, really good question though. What ETFs do I recommend? Ones that are balanced and non-levered. So don't buy levered ETFs. Buy ETFs that are well diversified, that are not levered. The second part of your question was about DRIP. So DRIP is a dividend reinvestment program. A lot of stocks have a DRIP you can buy, where basically they take the dividend you normally get in cash and they give you the right to buy the shares of the stock at like a 5% discount. So you can buy them 95 cents on the dollar, and you use your dividends and you reinvest into the company. So instead of getting 50 bucks cash, you get 2 shares at a discount, and your amount of shares grows. So you don't get any dividend payout, you get more shares. A DRIP program is great because the company doesn't have to put out any cash. They just issue you more shares. Or they basically just let you buy their shares. So it actually jumps up their price. So they like DRIPs. I like DRIPs because you get to buy the stock at a discount, so that's a win. Typically they don't issue the shares. Typically what they'll do is just give you them, you can buy them at a discount, I believe. And it keeps cash in the company, so they prefer a DRIP. But the last part of your question was, hang on, I'll grab it here, and I lost my spot. There it is. Okay, so do you start filling your tax-free savings account or your registered retirement savings plan account first? The question is, it depends. If you make 200 grand a year and you're at the top tax bracket, you should jam full your RRSP right now because you're in the top marginal bracket and you will never You can't get a better tax savings than that. Then with all the once the RRSP is filled up with all of your previous years, 18% every single year, and the 18% of your income from the previous year is full in your RRSP, then you can jump over to your tax-free savings account. It's a great place to put after-tax money because RRSPs, you put pre-tax money in, you get a tax credit, and your RRSP put after-tax money in, but they gross it up to make it pre-tax and give you credit back. So it's basically pre-tax money in your RRSP. And with your tax-free savings account, it's after-tax money that stays tax-free forever even when you pull it out. So I always rather put my pre-tax money in my RRSP and then put money in my TFSA after the fact. So RRSP first, TFSA second. If your income is very low and you're in a low tax bracket, TFSA probably first. Save your RRSP contributions for a higher earning year. That's the quick and dirty of the answer to that question. Got some great traffic in here. People are all here listening and learning. I'm glad. We got a lot of great people in here tonight. Mortgages are less than 2% now. That's very attractive. I got to take a look on ratespy.com and see for myself. Akira says, what industries are not negatively affected by the virus and at the same time positively affected by the cheap oil prices? I have to think on that, but you can just do a quick Google search. I'm sure you can find a lot of companies that would be positively affected in that way. So you could think of companies like, I don't know, low oil prices. I would think anything that's like involves a lot of shipping or freight or like a lot of any service industry that like requires a lot of gas to drive around or like a lot of trucking and stuff like that would be valuable. You can imagine a trucking company would do really well that was primarily worked on like shipping toilet paper. Like they would do pretty well because everyone's like buying toilet paper. It's like they can't even get enough of it into the stores, right? Or they sold like hand sanitizer, right? Those types of companies, like someone who drove truck for like their company just logistics. All they do is just drive materials to stores. People buy more than they need. Like people are filling their houses, their pantries with stuff, like groceries, whatever, just because they're worried about like this epidemic, right? And I'm not doing that because I know there'll be food in the grocery stores. I'm not worried. I don't think the world's going to end over this coronavirus. It's not killing anyone healthy. So that's the healthy people run the country. Let's be honest here, they do all the work. And it's not killing those people, so the country will continue to run. And automation being what it is, like pretty soon everything will be robotic anyway. I don't think we need to rely on people to do things. But for now, we still do. Anyway, that was a tangent, and I was just thinking out loud. Maybe transportation companies, obviously anyone who services, like medical, would do really well this time. Those types of companies would all do really well. If you're starting over today, if you're starting over today, sorry, my lip was a piece of dead skin on it. If you're starting over today and you have enough money to do only one deal, would you wait until after the bubble to invest or just buy now? Jason Young, good question. You never just have enough money for one deal. So that was a loaded question. It was a loaded question, I know it. Jonas, how you doing? Jimmy, I know you're watching. Of course Jimmy's watching. Jimmy Montoya, my boy. He's one of the newest mentees if you're following. Come say hi. Jump in the comments. I want to see you here. I want to know that you're watching. Or don't, because you don't want anyone to know your secret alias. Stay out of the comments. Okay, I don't know if they would qualify, but my dad has good credit, but he lives off credit and only pays the minimum. Yeah, I don't know if your dad would qualify. That's up to the lender. So I guess I'm still thinking about that question to answer it for you. It's a loaded question because you can never just do one deal. You can always do lots of deals. I think better to get into a deal now than to not get into a deal like 2 years from now, right? Because if you buy a deal right now and you buy it, let's just say it's the top of the market. I don't know. It could be next year. It could be the year after. We can see another 20% growth year over year. Analysts are calling for 20% growth still yet. So I don't know if it's the top. I have no idea. But let's just say there's another 20% growth. You can miss out on that 20% growth. And if you think about it, all that cash flow. What if you wait for the bottom of the market and it's like 2-3 years from now? 3 years at $1,000 a month is like $36,000 in lost cash flow you could have had. But more important than the cash flow, more important than the potential appreciation, is the knowledge you could have received You don't learn until you get involved. You got to get into a deal. You got to really feel it and experience it to really learn. And so I would argue that even if you bought a property and you didn't make cash flow and it went down in value and you went into a recession, you would have learned a lot. And so that is valuable. Like, to learn what I've learned in real estate, I would pay $100,000 to go to school to learn that, to learn all the, it's more valuable than my Ivy education that I paid $100,000 for, is the real estate knowledge that I have. And the only way to learn what I know is to do. Through failure, you will learn. And so my advice is just buy something. Go through the market, look for, look at 100 properties, but find something that cash flows. That's the focus. Find something that's got a lot of positive cash flow and buy it and learn. And by the way, don't just stop at one, because even if you have enough money for one, you can always find a joint venture partner to do a second deal. You can always raise the money for the second deal. You can always just partner up with someone or something like that, right? There's lots of options where you don't have to bring the money. You could bring the management. You could bring the labor, right? You could bring the deal itself, right? There's three to the pyramid, right? There's three things. There's the money, there's the management, and there's the deal. Okay. Next question. Keep buying cash flow in real estate during these times or hold for more cash? Colton, I think that it's prudent to buy where you see opportunities. Like, if I see a property that's, even at these crazy prices, that's 90 cents on the dollar, I'm still gonna buy it. If I see a property that has positive cash flow, I'll probably still buy it, especially because interest rates are so low right now. So re-lever your portfolio, grab all that positive cash flow and put it to work, right? This is the time to take your property that's got 200,000 in equity and pull that equity out. In the next month or so, I think Bank of Canada will cut interest rates another 50 to 75 basis points. So we will see a full 100 basis points or full 1% reduction in interest rates. That means we will see mortgages at 1.99%, 1.78, 1.89%. That won't be unheard of. We will see that. Go to ratespy.com, keep an eye out, it's coming. I'm calling it now, it's coming. So with those types of interest rates, it's hard not to cash flow. Pretty much everything cash flows. What that's going to do though, when everything cash flows and you can qualify at 1.79 for a mortgage and the qualifying rate's 3.79, that means anyone can qualify for pretty much anything. Where you could qualify for a $400,000 house, now you can qualify for a $500,000 house. And that $500,000 house, it cash flows because your mortgage is so low. Plan for 5% or 6% interest rates. But what people won't do is they won't plan for that. They'll look at the current numbers with their 1.79% mortgage and they'll be like, I have $100 in positive cash flow, I'm gonna buy it. And then when interest rates come back, they're gonna be cash flow negative, but it's gonna lead people to pay more for their property than they need to. And so that's where it's gonna get crazy. People are going to be bidding with these low interest rates much more than they should for properties. So it is gonna artificially increase the price of houses. People will buy more than they ever could before because they can afford more and because it's cheaper and because there's higher cash flow. So the short answer is, Colton, I'm also gonna keep buying, but only stuff that's really good. If I see a good deal, if I can buy it at 1.79 interest rate, I'm all about that. I wanna acquire another couple $1 million in debt at sub 2%. It's a good time for everyone. So yeah, I mean, get the equity out of your properties that's trapped and spread it out into more properties and sell the stuff that doesn't cash flow to the investors who will pay crazy prices. We are gonna see in London duplexes, like really big duplexes, go for $800,000-$900,000. I've seen one that might be $1 million. It's gonna happen. I'm calling it next year or so. And these interest rates are gonna drive it there. It's the gasoline on the fire that we didn't need here in London. But I stand to benefit, so can't complain. Paul says hi. Hi. Tell your mom first case of Corona in Hamilton confirmed today where I work. I'm okay. Thanks for worrying. The bright side is that when the virus kills the boomers and zoomers, we'll get cheap real estate, a lot of empty houses real quick. You know, I don't know if that's the case really. Like, I just don't see it killing a lot of people enough that it actually matters. Like, I don't see it killing, even if it killed 1,000 people in Canada, that would be like so few properties would be affected. How many of those people rent? Like 60, 70% of the population rents, first off. And most of the older people, they rent in old age homes. So like as a percentage, they probably, a lot of them rent. So right there, like 500 of those cases probably don't even affect houses at all. The other 500, probably like the grandparent dies, but the kid's living with the grandparents, so they just keep the house. So like, I bet you if 1,000 people died in Canada, which is like a lot of deaths, that would be like news making. That wouldn't even affect the real estate market. Like that'd be, yeah, so my opinion is that it's not going to affect real estate in a large way. Other than like, I thought it might affect the speculators. People wouldn't want to speculate on real estate. But with interest rates dropping, let's say like down to like 1.99% for mortgages, people are still going to speculate because the debt is so cheap. When you give people free money, like it's hard not to spend it. Even if there's a coronavirus, it's the bank's money anyway. People are just going to start spending it, a ton of it. So that's the intended effect, I guess, by lowering interest rates, is to push the economy, and it will. Is it a good time to cash out refinance? Juan, yes, it is a good time to cash out refinance. It is like the best time in the next like 60 days or so. Probably if you wait a little bit longer, you'll get a better interest rate. Thank you, Mike, for sharing your knowledge. When you convert a single house to a secondary dwelling unit, is there lots of comparable price for appraisals when you refinance? It depends on the area. Look at the comp. Some areas have a ton of duplexes that have sold. Go pick out what your property is going to look like. Go find properties that have sold like that, and then you have comps. Simple as that. But is there tons? Yeah, probably a lot of sales that will be what your property will be. Hey, no problem. Happy to help, Michael. How important is the 1% rule when buying? Duplexes are $625,000 running for $3,300 a month for the 2 units. So I wouldn't touch that property with a 10-foot pole. Terrible. Don't buy it. If you own a property like that, that's worth $625,000 right now, that's rented for $3,300 a month, probably sell it in the peak of the spring. So can I analyze a property? Maybe. Is it illegal to put ownership of asset in someone else's name and have them claim that income and pay a lower tax rate and then have them gift you the money? So, yes, technically, I think that's illegal. Or I don't know. It's probably tax evasion. You could just give the ownership to someone and then, yeah, I mean, I'm not going to talk on camera about that at all because I don't want to give anyone any wrong advice. Don't do that officially. What advice would you give to someone that wants to invest in their first property but does not want to be locked living in that area in case their job situation changes and they're forced to move? Well, Chris, buy something that cash flows. Buy something that if you had to move, you would keep and that you could rent out and make great cash flow. That probably means not buying a single family house. That probably means buying a duplex or triplex, or a property near a university that has a lot of bedrooms. So then when you move, it still is 1% rule, cash flow positive. You're paying $400,000 for the property, can rent for up to $4,000 a month once you leave. So that's like a good rule of thumb to kind of stick to. Okay, I got a lot of questions to keep getting through. Mike, I do think there are some issues. Valuations by cyclically adjusted PE or market cap to GDP very high in the US. Although there's a lot of debt out there. That's true, William. There are a ton of companies that are overvalued, that their price to earnings, their PE ratio is way off. A correction's been needed for a long time in a lot of areas of a lot of sectors, to be honest. So this is long overdue, admitted. I agree. The second part of your question was, holy moly, I gotta scroll. There, I found it. There's a lot of debt. So yeah, there's a lot of debt out there. There is, especially in Canada, we have the highest per capita debt, so debt per person of any developed nation, and a lot of unsecured debt. It's scary. So the decrease of interest rates is going to help that situation in the sense that like the payments will be lower, but destroy these people's lives as they lever up further and borrow and take on more debt because it's so cheap. So yeah, it will be the demise of some people who can't, who don't lever up smartly. You have to lever up smartly against really strong cash flowing assets. Don't lever up to buy a car. Don't lever up to buy stocks. Don't lever up to buy something that doesn't self-service or that depreciates or that has a high risk because you might be screwed. Don't lever up to buy stuff. Don't buy stuff in general. Try to avoid that. Buy assets that appreciate in value, that cash flow, that are diversified and stable. But in general, you're right. The US has too much debt in general. Like the United States of America has too much debt. And that's why they're cutting the interest rates partly, is to keep themselves afloat. It's part of why I believe we will never see the 1980s interest rates. It just won't happen. The government will collapse before they allow that to happen. So I just don't think we'll see it. Hey, Mike, just finished the podcast you did about real estate investing. Cool. I don't know which podcast that was, Brandon. Maybe on Irwin's podcast. Could be. I've done a few podcasts, so you have to enlighten me. You said, can you talk about the Airbnb workaround for A-lenders in more detail? Would you have the property in your name and rent it out monthly? So Brandon, at a high level, I'm not an accountant, and I will say that whatever I'm about to say is just my opinion, and I have no idea if it works for you. Do what you want to do. Don't take my advice. And this is not advice at all. It's just something that I've seen done that I believe does work. So that's my preface. Here it is. If you're going to put a property on Airbnb and it's in your own name, open a company, open a corporation, have the corporation rent the property for a set amount of money, and then let's call it $1,000 a month or close to market rent, whatever you want to do. You could actually do it less than market rent if you wanted to, I guess, because it's your own company. You want to give them a bit of a discount. Then that company puts it on Airbnb, and instead of making $1,000 a month, makes $3,000 a month on Airbnb. Now the company is protected, so you're not liable for anything that happens. The company that you own is renting from your property the unit and putting it on Airbnb, so you're insulated from a liability perspective, but moreover from a tax perspective and to A-lenders. When you go to the bank, you don't have your property on Airbnb. You just rent it out to some individual on a long-term lease. You can provide that lease. Yeah, I rent it out, and then they re-rent it. I don't know what happens there, but I've rented out to a company. Here it is. Further, the property does not get triggered to be a commercial property. If you put a property on Airbnb, you have to charge HST once you get more than $3,000 a month on average in income. A lot of properties on Airbnb make a lot more than that. Most single-family houses will make more than that on Airbnb. Most duplexes, triplexes, they all make more than that on Airbnb, almost guaranteed, unless you're doing something wrong on your Airbnb. But in short-term rental Airbnb, you want to protect yourself from your property becoming commercial. If it becomes commercial, the sale of the property now has HST involved. A $500,000 property with 13% HST means you got to pay $60,000 or $70,000 in HST on the sale of the property. You don't want your property to become commercial. You want it to stay residential. So how do you keep it residential? How do you keep it on board with residential? You rent it out to your company puts it on Airbnb, your company makes the difference as profit. So it pays $1,200 back to you, you file your T776, you claim your regular rental income, you have a small profit personally, but all the rest of the profit that's made from Airbnb is in the active business at 13.5% tax rate because it is an active business. You opened a company that does full service Airbnb management. It does the cleaning coordination. It does the maintenance. It actually actively provides a service, right? So it's an active, solid, real business. The business can also get unsecured lines of credits now because the business is an active, real business. It has tax shelters. It has tons of advantages at a high level. That is how I would structure. That is how it should be done. I don't know, talk to your accountant, but that is my understanding of how it should be done in Canada. From a liability perspective, from a tax advantage perspective, I don't know. Because again, someone's gonna come after me and be like, oh, Mike, you said this was the way to do it and I did it, didn't work out. So do whatever you want, don't hold me liable. That is the way that I am choosing to do it. So yeah. So the spouse would then claim the monthly rent for taxes and would claim Airbnb for her taxes. Yeah, that is one way to do it too. You could just rent it to a friend could put it on Airbnb, they can make all the profit, they can claim that as their little sole proprietor business, and they would have write-offs. The cool thing is, guess what? All your gas and your car expenses are tax deductible now to managing your Airbnb rental. So now you have a place to write it off in your company and a place to write it off against your property. So you have two write-off sources now. It's a much better way to do it. It's a lot more paperwork, it's a bit more convoluted, but it is the safest way that I can think of to so set up an active management company that does Airbnb management to protect yourself. Good question. And I'll message you, by the way, on another front about that property. We should get listed. Cheryl, Mike, do you think I should wait to refinance our mortgage? If yes, do you think rates will go down more in the next couple months? Yes, I think you should wait a little bit longer. I'm planning to also wait, maybe lock in a rate now and then wait and see if rates go lower and lock it in again. So just don't commit to anything. And even if you commit to it, you could probably jump before they funded to a different term or rate. I do agree cash flowing real estate is a good place to be, and I need to refi. You do need to refi. Get the cash out now while you can. I'm of that opinion. But maybe wait, William. It's not a big deal to wait another month or two because I think the Bank of Canada and the Feds are going to cut interest rates slightly lower yet. What is a good business to learn how to become a real estate agent or property manager? So you're asking like a good business to be in to learn about real estate. Well, there's tons of sectors you can be involved in to learn about real estate. Yeah, you're right. Anything from broker to real estate agent to anything involved in real estate, construction, general contracting, high level, you could work in like the financial sector at a bank, and often you'll overlap with some of the pieces you need to understand in real estate, right? To do well in real estate, you need to understand sales, you need to understand people management, you need to understand negotiation is an important piece, especially with contractors, with sellers on properties. You need to be able to understand project management. So how do you manage multiple things? Like there are materials that need to be there tomorrow, and you need to think about that before the contractor does. Because by the time he's thought of it, it's already halfway through the day and you're wasting time. So you need to be thinking ahead. A good project manager knows what's coming before it comes, and they plan accordingly for those things, right? They know how to allocate their resources and plan as such. So any job where you're doing project management, where you're doing sales, negotiation, people management, just general construction, all those things, those fundamentals are really, really important in doing well in real estate. Everything from like how property is built to managing people to negotiating. Those are the 3 highest value skills that I can think of. Great questions. We're going to a lightning round because it's getting close to the hour mark in like 3 minutes. So you guys ready for the lightning round where I talk so quickly that when you watch the replay, you're going to have to put it on 0.5 to 0.75 speed. I'll slow down a little bit for you guys. It was too fast for people last time. I do agree, cash flowing real estate is a good place to be. I need to refi, definitely. Next question. What is a good business to learn? We did that question. Next one. Good point about the healthy people running the country. I just saw no TP available at Zaire's. Jimmy, I know you're watching. I love you too, buddy. Mike says, how much does the ARV increase by adding a 2-bedroom secondary suite basement conversion to a 3-bedroom bungalow in Northeast London? In general, it's hard to know like how much value it's adding without looking at the comps. Northeast London. So if it's kind of close to Fanshawe, it could add like $1,000 or $1,200 a month in rental income to your property, in which case that'd be worth about $120,000 in resale. That's just a rule of thumb. I don't know, but if you're spending $50 grand to do the renovation and it unlocks $120,000 in value, you just made $70,000. That's a win. Hey, Ivan, good to see you on. Bruce, to answer the question, it's 0 market value. I missed that question. Bruce. I don't know, Jonas. I kind of disagree. I think that if it increased cash flow or it was a legal, if you legally added the suite, then I think it would add value for resale. Mike, do you have any experience with vertical split duplex conversions? If so, do you recommend this approach? Yeah, I like vertical split. I like horizontal split. Both can work. It depends on the layout. It depends on the property. Anything to watch out for. It depends on how it was built, when it was built. If you give me the era of the house or the style, I could tell you things to look out for. I know when you're stacking units on top of each other, look out for sound transfer. So when you can get units side by side, that's much better than having them stacked, because then the tenants aren't on top of each other. So you get a better tenant quality, better tenant experience, better tenant profile. Yeah, so side by side units, way better than stacked if you can get it. But yeah. Keep buying, we don't know the market. This is true. Dollar cost average is if you keep buying forever, you will weather any single recession, because you've bought in the lows and you bought during the highs and you bought on average through everything. Wouldn't it make more sense that people will be taking money out of real estate and into the equity market because everything is negative 20% on sale? You said you're going to refinance and put it in stocks. I think that people don't sell real estate by and large. I think that what we see is people hold real estate for a long period of time. That's typically what happens. We see people, it's not very liquid, right? No one just irrationally sells like they do a stock. A stock's liquid. You put it on the market, it's gone, like that. A house takes months to prepare for sale, then you gotta put it up for sale. There's no, the liquidity isn't there like it is with a stock. People don't typically make irrational decisions in the same way. So I will say that, first off. Most people are worried about the tax consequence of a sale. So they're like scared of the capital gains. Everyone thinks it's worse than it is. For some reason, people think it's like 50%, but it's actually 50% inclusion rate. So capital gains tax is like 23% at the highest. But people think it's always like 50% of their gain is taxable. So I'm coming, Emma. I'm coming, my girl.
I'm about time.
It is bedtime. Can you take 2 minutes? You're not supposed to be on camera. Mom doesn't want you to see you on camera.
Why?
Mommy is very upset when you get on camera, so I can't let you get on camera, my girl. You've got in here, you gotta go, okay?
Mommy said right now.
Right now, did she?
Yeah.
Well, she's gotta wait 2 more minutes. I gotta do my lightning round here. Sorry, guys, I gotta go. It's bedtime, and it's right now, apparently, so. The short answer to your question is most people will just refinance the capital out rather than selling the property.
Daddy.
Take action in any market, learn through doing, 100% agree. Only affects will be the first time home buyers using RSPs with a 25% haircut. Yeah, I don't know how much of that drives the market really. I think mostly it's investors with lots of money that own multiple properties. I was saving to buy a house in Alberta for the first time, and room hack, oil dumps, and market crashes, and now my province is going broke. Yeah, it's sad life in Alberta right now. Learn to earn. Should I get a job as a real estate agent or property manager? Yes, I think. Can you analyze? Oh, I just saw a super chat pop up. Akira says, thanks for sharing your knowledge. Thank you, Akira. Appreciate the $5. You keep the channel alive. Okay. I was saving to buy a house in Alberta. We did that question. Next question. Can you analyze this property for me? I don't see the property, so I think if you send a link, I can't see it, so I don't know what the details are. What if you want to buy now and can't find anything better than $100 cash flow, just on the sidelines networking and hope it leads to something? Harriet, you could JV partner with someone. For instance, like I JV partner all the time, and my JV partners typically over a long period, like 5 years, will expect an average of about $500 to $1,000 a month in positive cash flow. So find someone in that market and partner with them. I'm not looking actively for JV partners right now, but find someone and actively invest with them, or find someone and lend them money. That's always a good way to do it too. Mike, I can blend our mortgage rate without penalty, but the spread isn't saving me money. That's why I'm thinking to wait to see if rates go lower further. Yeah, Cheryl, great point. Depending on your mortgage breakout terms and the penalty associated with that, it might not make sense to break out of your mortgage. Over a 5-year period, it will. And if interest rates get lower, it might. But the problem is the breakout fees get larger because the interest differential is bigger. So the breakout fees get bigger the lower the rates go. Is creating a business for the sole purpose of tax evasion not tax evasion? No, so what I'm suggesting would be creating a business to actively manage your Airbnbs, because you need a business to manage that. You could hire someone to run your Airbnbs for you and pay them 20 to 25%, typically 25% of revenue to run that plus fees, or you could start your own business. And I'm suggesting if you want to run Airbnb, it is a business, and you should start a business to do like a company to run that business, as opposed to trying to run a business personally without a corporation. That's just liability risk. So I'm not suggesting tax evasion. I'm suggesting that if you're going to run Airbnb, you're already running a business, set up a company for that business. Can you quickly outline your strategy for refinancing? Did you say you were going to wait? What rate do you think you can get? I refinance as much as I possibly can out of the property at as low as rate as I possibly can. That is the strategy. I'm going to wait because the Bank of Canada is going to cut interest rates further. I am almost sure of it in April, so we will see. Mike, if you were starting a new company, what would you go into now? Bath time. Yes, it is bath time's done, but it is now book time and bedtime. What would you go into now if I was starting a new company? I don't know, something I had passion for. That's the key. Do something you love. Hey, Mike, I heard you suggesting waiting out a refi, getting interest rates. Do you suppose property prices will start to go down? No, I think they'll probably go up.
Daddy,
Thank you, everyone. I gotta go.
bedtime now.
It is bedtime. Gotta go. Bye, everyone. Remember, the secret to unlocking a wealthier you, to unlocking that wealth, 3 things you can do. 1, spend less. 2, earn more. And 3, maximize the returns on the difference. Thank you, everyone, and I'll see you next week and in the comments. And if I missed your question, throw it in the comments, and I'll be sure to answer it. Bye, everyone. Happy Wednesday.